The $936 billion debt bomb set to explode in 2026. There's a massive time bomb hidden deep inside America's banking system, and its fuse is getting shorter by the day. By 2026, it's set to go off. Most people think the banking scares of 2023 were a one-time thing. They were wrong. What happened at banks like Silicon Valley Bank was just a tremor. The real earthquake is still on its way. In this video, I'm going to show you a hidden four-stage pattern that reveals why this crisis isn't just a possibility. It's a scenario backed by some brutal math, and it's shaping up to be far more widespread than the 2008 collapse. The problem, the wall of debt. You remember 2008? The bad mortgages, the banks failing one by one, the bailouts. It was a crisis born from toxic debt that was hiding in plain sight. Well, a new crisis is brewing today, and while the ingredients are different, the recipe for disaster feels eerily familiar. This time, the problem isn't in houses and condos. It's in the office towers, shopping malls, and apartment buildings that make up the world of commercial real estate, or CRE. And the numbers? They're staggering. According to an analysis by S&P Global Market Intelligence, a colossal $936 billion in commercial real estate loans are scheduled to mature in the year 2026. To put that in perspective, it's more than the entire GDP of many developed countries. It's a mountain of debt so huge that people in the know have given it a name: the Great Maturity Wall. This isn't some far-off problem. It's a crisis that was built over the last decade and is now barreling straight at us. For years, as loans approached their due dates in a tough economic climate, borrowers and lenders did the easy thing. They chose to extend and pretend. They kicked the can down the road, pushing loan maturities forward and concentrating them into one massive, unmanageable pile set for 2026. As a result, the amount of debt coming due in 2026 is now projected to be nearly 19% higher than what's slated for 2025. This isn't just 1 year's worth of debt. This is a backlog of risk, a compressed spring of financial obligations that's been wound tighter and tighter. In 2026, it's set to release. This pile of debt is the explosive charge, but what's lighting the fuse? To get that, we need to look at the four-stage pattern that makes this situation so dangerous. This pattern explains why this isn't just a forecast. It's a simple, brutal equation heading towards a punishing conclusion. To understand the crisis of 2026, you have to rewind the clock to the world after 2008. To get the economy moving again, the Federal Reserve and other central banks slashed interest rates to near zero. For over a decade, money was cheap, incredibly cheap. During this time, real estate developers and investors went on a borrowing binge. They took out massive loans to build and buy office buildings, apartment complexes, and retail centers. And why not? With interest rates on commercial mortgages around 3 to 4%, it was practically free money. Property values seemed to only go up and loans were easy to get. These weren't 30-year fixed-rate mortgages like you have on your house. The standard in commercial real estate is often a 5, 7, or 10-year loan with a huge balloon payment at the end. The business model was simple. Take out a loan, let the property's value rise for a few years, and when the bill comes due, just refinance it, pay off the old loan, and pocket the difference. For a decade, this model seemed to work flawlessly. It was a game of financial musical chairs where the music never stopped. The loans that make up the $936 billion maturity wall of 2026 were almost all born in this era. They were created with one fundamental assumption: that when they came due, the world would look the same. That property values would be higher, and cheap, easy money would be there to refinance them. That assumption was catastrophically wrong. Starting in 2020, Two seismic shifts shattered the foundations of that old world. The first was the pandemic-fueled rise of remote and hybrid work. It sparked a massive structural change in how we live and work. Suddenly, those gleaming office towers in major cities, the very assets backing billions in loans, started to empty out. The 5-day commute became a relic for millions. As companies realized they could function with less office space, they started downsizing. By late 2025, reports from market trackers showed national office vacancy rates hovering around 18–20%. In major cities like San Francisco, it was even worse. This created a flight to quality where tenants fled older buildings for brand new ones, leaving a trail of half-empty properties behind. With fewer tenants, rental income plunged. And when income plummets, so does the property's value. The second shift was the Federal Reserve's war on inflation. To control runaway prices, the Fed launched one of the most aggressive interest rate hiking cycles since the early 1980s. The era of cheap money was officially over. That 3.5% loan from 2016 was now facing a refinancing world where new rates could be 6.5%, 7%, or even higher. This created the perfect storm. The very assets that were supposed to have gained value were now worth significantly less. At the exact moment the cost to borrow against them went through the roof. This brings us to the cold, hard math of Stage 3. Stage 3, the mathematical trap, the unsolvable equation. This is the part of the story that Wall Street hopes you don't think about, because it's not based on speculation, it's just arithmetic. It's the reason we can say this situation is a ticking time bomb. Let's walk through a typical example. Imagine a developer bought an office building in 2016 for $50 million. They took out a $35 million loan at a 4% interest rate, due in 10 years, in 2026. Back then, the building was fully leased, generating great income and easily covering the mortgage. Now fast forward to 2026. That $35 million balloon payment is due, but the world is a different place. First, thanks to hybrid work, the building has lost tenants. Its occupancy has dropped, and so has its income. Second, because of higher interest rates, the building's value has plummeted. A property's value is largely determined by its income and something called a cap rate. As interest rates rise, cap rates rise, which pushes property values down. That $50 million building might now only be appraised at $35 million or even less. So the owner goes to a bank to refinance their $35 million loan. The bank runs the numbers on this new reality. They see a property with lower income and much higher risk. They won't offer a 4% loan, they'll offer a 7% loan. The bank looks at the property's reduced income and calculates the biggest loan it can support, while still meeting its required debt service coverage ratio, a key safety metric. Because of the lower income and the much higher interest rate, the bank says the property can now only support a new loan of $20 million. This is the mathematical trap. The owner owes $35 million, but can only borrow $20 million. They have a $15 million gap. Where does that money come from? The owner either has to find $15 million of their own cash, which they likely don't have, or they have to default. Now multiply this exact scenario across tens of thousands of buildings. That's the ticking time bomb. Research from firms like TREP, which tracks this data, confirms the scale of the problem. Some analyses show that a significant percentage of maturing commercial loans could struggle to qualify for refinancing, with the office sector facing the biggest hurdles. There is no easy way out. The math often just doesn't work, and that leads directly to the final, most dangerous stage of the pattern. Stage 4, the regional bank connection, the weakest link. If this was just a problem for a few rich developers, it wouldn't be a systemic crisis, but it's not. The real danger is who holds this debt. You might think it's the huge, too big to fail banks like JP Morgan Chase or Bank of America. You'd be wrong. While the giant banks have some exposure, they learned their lesson in 2008 and are more diversified. The real holders of this ticking time bomb are America's small and mid-sized regional banks. The numbers are terrifyingly clear. Multiple analyses have confirmed that smaller banks have a much higher concentration of their assets in commercial real estate loans than their larger peers. For many of these smaller banks, CRE loans make up a staggering portion of their balance sheets. Some reports put it over 28%, compared to just 6.5% at the giant banks. These are the local banks that give out small business loans and finance community projects, and they are frighteningly overexposed. Banking regulators have a well-known red line. They consider a bank to have excessive CRE exposure when its portfolio of these loans exceeds 300% of its total equity capital. This isn't just a theoretical number. When the property owners from Stage 3 start defaulting, it's these regional banks that will be forced to take the losses. Unlike the big banks, they don't have massive investment banking divisions to cushion the blow. Their capital buffers are much thinner. The failure of Silicon Valley Bank showed us how fast a regional bank can collapse when its assets lose value. But that was about losses on government bonds. This is different. This is about losses on the core business of lending, concentrated in the very institutions least equipped to handle the shock. The failure of not one, but potentially dozens of these banks could trigger a credit crunch that starves the real economy of capital and sets off a domino effect that some fear could be even more disruptive than 2008. So what happens when the fuse on this maturity wall finally burns down in 2026? The data doesn't point to a single dramatic explosion. Instead, it's better to think of it as a rolling crisis. The distress is already here, but the sheer volume of debt concentrated in 2026 is what threatens to turn that wave into a tsunami. We are already seeing the warning signs. Delinquency rates on the riskiest slices of commercial real estate debt, known as commercial mortgage-backed securities, CMBS, have been climbing steadily. By late 2024, the delinquency rate for office loans within these securities had already spiked to over 10% according to TREP, a level surpassing the peak of the 2008 financial crisis. This is a flashing red light for where the trouble is most acute. Now, some will argue there are factors that could lessen the blow, and there are. Private credit funds have raised huge sums of money to pick at the bones of distressed properties. Some loans will be restructured and others sold at a discount. Not every loan will default. But these are like bringing buckets of water to fight a forest fire. They can help at the margins, but they can't solve the fundamental problem of scale. The refinancing gap is simply too big, and the losses have to go somewhere. The extend and pretend strategy has run out of road. 2026 is the year the bill comes due. The evidence from this four-stage pattern, the cheap debt, the brutal reversal in rates and values, the inescapable math, and the concentrated exposure of regional banks, makes a period of severe distress look almost unavoidable. The real question is, how bad will it be, and will you be prepared? This is a story that will define the next 2 years. The shockwaves from this commercial real estate downturn won't be contained to Wall Street. They will impact the availability of credit for small businesses, the stability of our local banks, and the health of the entire economy. If you want to stay ahead of this crisis and understand what it means for your money and the financial system, you need to subscribe to this channel and hit the notification bell. Because the information you've just heard is only the beginning. In our next video, we'll break down which specific types of banks are most at risk and show you the tools regulators are using to track this exposure. We'll look at the cities most exposed to this crash and discuss what it could mean for you. You won't want to miss it. The numbers don't lie. A storm has been gathering for a decade, and in 2026 it's forecast to make landfall. The bill is coming due. The only question left is who will be forced to pay it.